Hello everyone, and welcome back to another video from Strategy 4 Capital. In today's video, we're taking a closer look at Stellantis, a once highly profitable automaker that is now navigating a challenging transition period. Following the merger of FCA and PSA, we'll walk through what has happened since the merger, the key strategic decisions management made, and how those choices have shaped the company's current financial and operational position. First, we'll go through the timeline of events and the major strategic moves that led Stellantis to where it is today. Second, we'll analyze market share trends and place Stellantis within the broader global automotive market. Third, we'll briefly explain the specific characteristics of the automotive business, including its cost structure and cyclicality. And finally, we'll discuss current market sentiment, the growing impact of Chinese automakers, and what all of this means for Stellantis valuation. In 2021, FCA and PSA merged, creating the Stellantis Group. This happened right in the middle of the COVID period, when vehicle prices started to rise sharply due to a global semiconductor shortage. At the same time, Stellantis closed a manufacturing plant in the United States and relocated part of its production to Mexico, primarily to benefit from lower labor costs. In 2022, vehicle prices continued to increase, and consumers faced longer waiting times for new cars as the chip shortage persisted. During this period, Stellantis pursued an aggressive cost-cutting strategy, significantly slowing down new model launches. This combination of limited supply and strict cost control resulted in exceptionally high operating margins, exceeding 11%. However, management has since acknowledged that these margins were cyclical and expects mid-term margins to normalize to around 6 to 8%. In 2023, Stellantis introduced its long-term strategy, Dare Forward 2030, with a strong focus on vehicle electrification. At the same time, as chip availability normalized, competitors began cutting vehicle prices to stimulate demand. Stellantis, however, largely kept prices elevated, which led to inventory buildups at dealer level. This imbalance became a major issue in 2024, when excess inventories translated into significantly lower revenues compared to 2023, marking the start of more visible operational challenges. Then, in 2025, the situation deteriorated further as the Trump administration introduced new tariffs, which disproportionately affected Stellantis due to its production footprint in Mexico and Canada, serving the U.S. market. This exposure is critical, as over 50% of Stellantis' operating profit is generated in North America. At the same time, a stronger euro further pressured results, leading to lower realized vehicle prices in euro terms due to FX effects. To mitigate the tariff impact, Stellantis announced substantial capital investments aimed at reopening and expanding production capacity in the United States in an effort to localize production and reduce tariff exposure. Overall, it's a fascinating case study of how a company moved from record profitability to a complex transition phase, shaped by strategic choices, market dynamics, geopolitics, and macroeconomic forces. 3 Next, I want to show you how Stellantis has been losing market share, even during a period when revenues were reaching record levels and operating margins remained exceptionally high, above 11%. When we focus on Europe and North America, which together account for more than 70% of Stellantis' total revenues, a clear pattern emerges. Market share has been declining consistently across both regions. In Europe, a significant portion of this lost market share has been captured by Chinese automakers, who have rapidly expanded their presence, particularly in price-competitive segments. In North America, however, the lost share has largely been redistributed among existing incumbent manufacturers, rather than new entrants. Look at Q3 2025. It becomes clear that foreign exchange movements had a material negative impact on revenues, with the stronger euro significantly reducing reported results in euro terms. At the same time, Stellantis has been one of the most affected automakers when it comes to tariffs, given its production footprint and high exposure to the US market. When it comes to capital expenditures, Stellantis has historically operated with capex at around 5 to 6% of revenues. Looking forward, management has guided that this figure will increase to around 8%, reflecting a structurally higher investment cycle. On the positive side, Stellantis stands out among European OEMs due to its exceptionally strong balance sheet. Compared to peers, the company carries relatively low leverage and, until recently, even held more cash than debt, providing an important buffer in a highly cyclical industry. That said, the automotive business is extremely sensitive to costs, as fixed costs are very high. If volumes decline, fixed costs quickly erode profitability. This is particularly relevant for Stellantis, as it is the second largest automaker in Europe by production capacity, after Volkswagen. Underutilized capacity limits operating leverage and puts additional pressure on margins. At the same time, Chinese automakers have aggressively expanded into Europe, the Middle East, and South America, supported by heavy price discounting. Even though Europe has introduced significant tariffs on Chinese vehicles, many Chinese manufacturers are still able to absorb these costs and remain price competitive. It's important to note that China produces more than 30% of all vehicles globally, and in the EV segment, Chinese players hold a structural advantage due to their vertical integration and control over more than 70% of critical battery materials, such as graphite and lithium. This gives them a cost and supply chain advantage that few global automakers can currently match. Now, let's talk about valuation. I have to admit, it is extremely difficult to value a company that is in the middle of a restructuring, especially in the current geopolitical and macroeconomic environment, where outcomes can easily swing in either direction. Because of that uncertainty, I'm choosing to rely primarily on peer-based valuation. Even though I'm not particularly satisfied with it, it's more of a reference point than a conviction-based outcome. That said, it still gives us a useful framework for understanding how the market is currently pricing Stellantis relative to other automakers, focusing specifically on PE and PB multiples, which we consider the most relevant metrics for the automotive industry. Stellantis appears to be trading with an upside potential of around 15%. That said, the key question for investors is how attractive the risk-reward profile really is. Given the cyclical nature of the business and the structural challenges the company is facing. Thank you for your attention and for watching this analysis. I'll see you in the next video. This was Strategy for Capital.